Welcome back. We're doing the second part of chapter 4, which is closing entries. I have a few things here prepared, and where we left off last time with the previous video was that we looked at how to move from the adjusted trial balance to the financial statements, and we looked at the worksheet. We used a worksheet to help us prepare the financial statements, and that's what we did in the last video. So what we're going to do in this video is we're going to go from the financial statements and then work through the closing entries. Now, in order to do that, I've got a little bit of an example here, sort of a very basic example to help us see what the closing journal entries do and why do we do them. So let's take our situation. We're a consultant. Maybe this is our side gig. We have another job, but we've decided to, maybe have a little home office or something like that. So we've decided to open the business, and we're going to go ahead and put a few dollars, $3,000 of our own money into this business. So we invest $3,000, of which the journal entry would look like this, 3,000. And that means the business would have an investment of owner's capital of 3,000. So if we put this on the T accounts, that would be 3,000 here and 3,000 there. Let's say we wanted to take out a little extra money just to get our business up and running. We put 3,000 of our own money and we took out a loan. So that would also be cash of 6,000, but now we've got a liability called a note payable of 6,000. So let's go ahead and add our cash. So now we've got $9,000 in the bank or in our bank account, and we've got a note payable down here, which is a liability, and a liability is increased with the credit. And always remember, if it happens in the journal entry, debit, cash, credit, owner's capital, that's what happens on the T account, debit, cash, credit, owner's capital. Okay, so let's say we do a little bit of work this month. Let's say we're going to charge $100 for our consulting. We do 15 hours worth of work, and everyone paid us. Let's say that we require cash up front or something like that. So we're going to go ahead and receive cash of $1,500. Now, what does this represent? Well, this represents service revenue, right? This is revenue that we have worked and we provided the services. Therefore, we have been paid. And so again, we're going to have a bump up here in cash, and revenue is now going to go $1,500 because revenue is increased with the credit. Well, we decide out of the $100, we're going to pay ourselves a salary, and then we're going to put the rest of it into the business. So if we're paying ourselves $60, we're charging $100, we're paying ourselves $60 an hour. That means we're going to take out $900. So we're going to take out cash. So that's credit cash of $900. And what does this represent? Well, this represents a wage expense. This is something necessary for the company to run the business, i.e. our hours, our work. And so we will record a wage expense here for $900. And that is cash that is coming out of the business. Now, let's say we were expecting to work a few more hours, and so we decided that at the end of the month, we were just going to go ahead and draw some because maybe there was a minimum amount of money that we wanted to get out of this little business each month. And maybe we started in the middle of the month, we only worked 2 weeks. So we're expecting to work a lot more in the coming months. So we're going to go ahead and hit a draw. Again, a draw is withdrawing cash. So that's going to be $400. And it's coming out of owner's drawings. That's $400. So we've got another $400 down in cash, and we've got drawings of $400. And so now you notice that each one of these transactions has been put into their relative respective T accounts, and we should have all of the information here pretty well done. If I were to go ahead and take and figure out, there's only one, all the rest of them are single amounts, but if I were to figure this one out, this is 6, 7, 8, 9, 10, 10,500 minus 1,300. So 10,500 on the debit side, 1,300. So what is that? Is that going to be 9,200? You just sometimes when I'm talking, I just want to double check. So 10,500 minus 10,500 minus 1,300, right? So the balance in our account is going to be 9,200. Okay, well, let's go ahead and produce the financial statements out of this, right? We can go ahead. We've got plenty of information to do it. Our revenue was, if we look up here, our revenue was 1,500. I'm going to have to figure out how to put that lamp a little different place. 1,500. Our expenses are 900. Therefore, our net income is 600. Our beginning capital, where we just started this, so the beginning capital was 0. We invested, that was what this was. We invested 3,000 into owner's capital. We're going to add our net income, right? This comes across 600. And then we're going to take out the amount of money that we drew from our owner's capital. So we took out 400. And so that leaves us with 3,000 plus 6, that's 3,600 minus 4, so that's an ending balance of 3,200. And now we're going to take this number and put it directly right there. That's the ending capital amount. Cash, we have 9,200. That means total assets are 9,200. And remember, assets must equal liabilities plus equity. So the total assets are 9,200. What is our note payable? Our note payable is 6,000. And so you see 6,000 plus 3,200. Our total liabilities plus equity is also 9,200. So that makes sense. Our balance sheet works, and our income statement and statement of owner's equity all flow through from one to the other. Now, what are the closing journal entries? If you think about it, this is coming up just through here, through the financial statements. We've done just a simplified financial statements. Well, what do we need to do now with closing entries, and what are they? Well, you may have heard of people say closing the books, and I'll kind of give you maybe a couple of different explanations. One explanation is that at the beginning of next month, we expect cash to be 9,200, and we also expect that we still have a loan that we have to pay. In other words, these accounts don't go away. The owner's capital is still 3,200. But at the beginning of next month, aren't we saying, well, we're going to start over with all of our revenue. We want to start over at 0 and start counting from 0 on up. We're not going to start at 1,500. Expenses, in other words, this is how much we paid ourselves this month, but starting next month, we're going to pay ourselves starting at 0 again. And same with drawings. The drawings were for this month. So revenues, expenses, and drawings are for just a period of time, for a month or a quarter or for a year. Whereas the items on the balance sheet are sort of perpetual. They're permanent. Now they go up and down, but they always carry forward. So whatever cash you have, it doesn't go to 0 at the beginning of the month, not like revenue. The loan doesn't go away. So when I look at these accounts up here, I could say the cash, the owner's capital, and the notes payable, these are permanent accounts. And the revenue, expense, and draw, well, those are temporary. They're just for each month or each year or whatever the time period is that you do your financial statements. So if you notice, the temporary accounts, we need to figure out a way to make them 0 for the beginning of the year. And why do we need to make them 0? Well, first of all, that's just the common sense about how the business works. But looking at the financial statements, if you notice, we went through a series of calculations in the financial statements. We added income, we added revenue minus expenses equals 600. And what did we do with that 600? We added net income to capital, and we subtracted the drawings from capital. Well, the capital began at 0, but then it went up to 3,000. So what ends up happening is these two transactions we have done in the financial statements, but we have not duplicated them in the T accounts. And here's an example of what I mean. Here we've got owner's capital of 3,200, but if you look up here, owner's capital is still 3,000. In other words, we need to do a couple of journal entries to basically back up or to mirror what we've done in the financial statements. The financial statements is we've added net income to capital, we've subtracted drawings from capital, but we haven't done that up here yet. So whichever explanation works for you, it ends up being the same. We need to zero out the temporary accounts, and we need to put revenue, expenses, and drawings, and we need to combine them into owner's capital, because that's what we actually do when we calculate the statement of owner's equity. Well, let's do the easy one first, which is direct. If we wanted to take the drawings and make this account zero, well, it's got a debit balance. And so in order to make it zero, I have to credit it, and that will bring it to zero. Well, a credit to drawing, let me put that down here. A credit to drawing, 400. Now, where are we putting that? Well, remember the drawings was subtracted from owner's capital, from the capital. So if I'm taking it out of drawings and I want to subtract it from owner's capital, well, the positive side of owner capital is on the credit side. So the debit side is on this. So you can see here, I am taking the drawings and I'm subtracting it from capital. And the actual journal entry is going to be and you'll see this is a credit to drawing, which is what this is. That makes it zero. And this is, sorry, this lamp keeps getting in the way. The owner's capital is debited, meaning in this case, a debit is a reduction of capital. And that is matching what we see here. In other words, this journal entry is doing what we do when we make the calculation in the financial statement. So that one's fairly straightforward. What we're going to do now is we're going to mimic the net income. You can see here we added net income to capital. So we need to come up with something that is going to allow us to do the same thing that net income does. And we're going to create this very temporary account called income summary. And we're just going to use it to do this. We're just going to use the income summary to perform this action. So if I go up here to revenue, if I want to make revenue zero, I'm going to debit it, and that's going to make it zero. And the thing that we do with the journal entry is I said debit revenue to make it zero. And where am I going to put it? I'm going to put it in the income summary. So you see, I've taken it out of revenue and I've placed it temporarily in the income summary. So right now we have two of our three accounts that we need to zero out. Revenue has been zeroed out, drawing has been zeroed out, and now we're going to take the expenses out. We're going to credit the expense. That makes it zero. So we're going to have a credit to expense of 900. And again, we're going to put it in income summary. It's just going to be on the other side. So here, 900. And when we look at the balance in this count, don't we have 600? And I look here and I say, this 600 matches my net income. In other words, we've created this temporary account that allows us to clear out those other accounts that matches net income. So what we're going to do now is we're going to do a journal entry that mimics this or does this transaction. So in order to take this 600 out of income summary, I'm going to debit it. So I'm going to debit income summary. And I'm going to put it in owner's capital. So now the income summary is zero, and I'm going to place it in owner's capital. Now, when I do the calculation here of this T account, what does it come up to? 3,000 plus 600 minus 400. It is now 3,200. And that is exactly what we're hoping for. Now, this T account matches our calculation in the statement of owner's equity, which matches the amount that we have in the balance sheet. So the permanent account is correct. And we have now zeroed out the revenue, expense, and the drawings, and all we're left with the trial balance. So we've done the closing journal entries, which are these four. These are the four closing journal entries: the owner's capital, the drawing, the two items to put the income summary together, and then to put the income summary into the owner's capital. We have posted them to the accounts. We have zeroed out the revenue, expense, and drawings and posted it to owner's capital. And the closing trial balance would just be these three accounts. These are zero. And going into next year or next month, we have cash of 9,200, we have owner's capital of 3,200, and we have note payable of 6,000. And that would allow us to begin the next month, next year, fresh. Okay, so that is the closing journal entries. We have one extra thing that we need to discuss here on the last part of this chapter, and it's just more of a sort of an explanational thing. So let's go ahead and take a look at that. So the last thing we have to discuss is, well, up to this point, we've looked at a fairly basic balance sheet. And as we go along, we're going to take a look at a more sophisticated or a more complex balance sheet, is what we're doing now. And later on, we'll take a look at a more complex income statement. So when we have a balance sheet, this is called a classified balance sheet, meaning it has more information. And remember that all of the financial statements are done to give as much information as possible to the outside users of the financial statements, the bank or the creditors, the government, the IRS or investors. So here, this is an example of a classified balance sheet which gives more information. The big difference that you'll see right away is that the assets are divided into current assets and long-term assets. And same with liabilities, current liabilities and long-term liabilities. So let's first take a look at the assets and look at a couple of the categories we have. First of all, for something to classify as a current asset, it must be something that we can turn into cash, or at least theoretically turn into cash within a year. And we would list current assets in order of liquidity. In other words, the things we can turn into cash faster get ranked higher on the list. So what is the most cash-like thing? Well, cash. So cash gets listed first. Debt instruments, those are like bonds. We can sell bonds. There's a ready market for bonds, so debt instruments are easy to sell. Accounts receivable, well, there's a whole market out there for selling your accounts receivable. Now, you may not get, full price. You may have to sell it at 80 cents on the dollar or something like that, but you can turn your accounts receivable into cash. What is a notes receivable? So up to this point, we've talked about notes payable, but we haven't talked about notes receivable. A notes receivable is just the other side of a note payable. A note payable is a loan we take out, right? We promise to pay back and we get cash. Well, what happens if we loan money to someone? Let's say we loan it to a vendor who needs some help or something like that. Well, that would be a note receivable, meaning we loaned money out. That's an asset of ours because we're expecting to get paid back. And we're also going to receive some interest back. Inventory is another current asset, supplies, and prepaid insurance. And so you notice we have a subtotal here for current assets. Long-term investments, stock investments. Now remember, this is not our own stock. This is us purchasing stock of other companies. Investments in real estate. The next category is of long-term assets are property, plant, and equipment. So you may not necessarily know what that phrase means. That's a very common phrase, PP&E. Property is land. Plant is just an old word for factory buildings, but kind of represents, in this case, any sort of, structures or any buildings that we own. And equipment is just sort of heavy equipment that is long-term equipment. intangible assets, which we haven't mentioned before, but are definitely assets that the company owns. And those are things like patents or trademarks or copyrights. Now, the number seems very small, and we'll get into this whole discussion later on when we talk about intangible assets. But we can only put a few things. We can only, I guess, record a few things towards a patent or trademark. We can basically only record the filing fees and whatnot. But, if we have like a drug patent, you would think, well, a drug patent is very, very costly. Well, we'll find out later that all of that research and development cost we can't put on the value of the patent, and we'll learn why later on. So just recognize that intangible assets, while they seem kind of small, do represent a lot of value, even if the dollar amount isn't there yet, and we'll describe how that works. On the liability side, we have current liabilities, and liabilities, well, current assets are listed in order of liquidity, how fast we can turn them into cash. Liabilities, remember, are things that we owe. We have to pay other people. So they're like bills. And so current liabilities we list in order of maturity, meaning when do they come due? So here you notice that both in the current liabilities and in the long-term liabilities, you'll see notes payable. Well, what we're saying here is current liabilities are all those bills that are coming due in the next 12 months. So perhaps we have several different loans, and some of the loans are coming due really quickly, which is the 11,000. And we still have some loans that are not due until the following year or afterwards, and that's the 1,300. So accounts payable is another current liability, unearned service revenue, salary payable, interest payable. Long-term liabilities, a mortgage, a note payable, that's the long-term portion of a loan. So if we've got multiple loans, some loans are going to be due soon, some loans are going to be due after 12 months. And then right now, as far as we'll have a more sophisticated equity section later on, but right now we only really have one item in the owner's equity, and that's owner's capital. Okay, well, that's the definition of the classified balance sheet, and that's the end of chapter 4. Good luck, and if you have any questions on the homework, let me know. The homework should be due, I think, next Thursday. All right, have a good weekend.